Going public is often considered the finish line, but for investors, business leaders, and analysts, it is really just the starting block. Because while IPOs open up capital and market exposure, then what? That's when the real challenge begins. How do companies transition from newly listed to mature, public companies that build value? And most importantly, what dictates that they maintain success or quietly fade away? The path from IPO to market maturity is not a straight line. It's a strategic journey through critical phases, each with its own character, risks, and investor expectations. We will dissect those 4 phases: early public growth, transition to maturity, and maturity with real-life examples and analysis that are relevant to both company managers and market observers. Immediately after listing, companies enter the early public stage. Investor interest is keen, share prices are volatile, and the biggest challenge? Living up to expectations set during the IPO process. That is where investor relations enters the picture. Management needs to communicate well, execute consistently, and establish credibility in a highly transparent environment. Miss a target? The market reacts in real time. But meet or exceed expectations. You set the stage for long-term investor confidence. Research shows that those with more wholesome sales at IPO fare better here, whereas weaker fundamentals can struggle more to keep up with post-listing expectations. With the foundation in place, the attention turns to scaling. This is the growth phase where companies use IPO proceeds to fund growth. That can mean pushing into new markets, building out product lines, or acquiring complementary businesses. It is a game of capital deployment, and the objective is to turn investor capital into compounding, sustainable revenue. Meta, formerly Facebook, is a textbook case. After its IPO, it invested heavily, building out its user base, acquiring Instagram, and building out its advertising platform. At this point, reinvestment takes precedence over payments to shareholders. Dividends, unusual. Every dollar is about market share acceleration and operating scale. But growth at any price does not go on forever. Eventually, companies face slowing growth rates, increasing competition, or market saturation. This is the transition to maturity. It requires a strategic shift in direction. Operating efficiency moves to center stage. Cost control, process improvement, and resource redeployment become the focus. Companies may begin to streamline organizations, rationalize SKUs, or tighten up capital expenditure. According to recent studies, companies that invest IPO proceeds in fixed assets and working capital, rather than overextending themselves, tend to perform better in the long term. Think of this stage as the bridge between growth story and stable performer. It's also where strategic mistakes are costly and where company leadership and governance distinguish themselves. In the final stage, market-matured companies fall into a routine. Growth is more aligned with the broader economy. Risk appetite diminishes. Mature companies have a tendency to offer stable margins, pay regular dividends, or commence share repurchases, lower PE multiples due to lower growth expectations, and prioritize long-term capital efficiency over aggressive growth. Microsoft is a great example of this. After maturity, it reinvented itself through cloud computing. It maintained strong dividends and investor confidence. Mature firms also hold excess cash and working capital, and liquidity management and capital deployment become critical in sustaining shareholder confidence. The cold, hard facts are that most IPOs underperform in the long run. Research and market data suggest that the average holding period returns of IPOs are typically underperforming the relevant benchmark indices over the long term. Why? Overvaluation, lack of a post-IPO strategy, or poor investor communication can all kill momentum. The most successful transitions? Good governance, strategic agility, and a sharp sense of capital markets drive them. For investors and analysts, understanding where a company is in its life cycle helps them with valuation, expectation setting, and identifying long-term winners. In short, navigating the equity maze takes more than a successful IPO. It takes foresight, discipline, and the ability to evolve. Get bullish about learning.